Good afternoon, everyone. Before we get started, I'd like to begin by acknowledging the traditional custodians of the land on which we meet today, the Gadigal people of the Eora Nation, and pay my respects to the elders past and present. My name is Yasmina Elshafei. I'm a Managing Director and Head of Carbon at CBA, and I'll be moderating the panel today. So I'd like to thank you all for joining us today for the webinar entitled The Reformed Safeguard Mechanism Sets a Carbon Price for Industry. As I'm sure you've all heard and seen in the press over recent months and weeks, agreement has been reached to implement proposed safeguard mechanism reforms set to take effect on the 1st of July. So we're delighted you're able to attend this session with us. And without any further ado, I would like to introduce our expert panel. We'll be hearing from Scott Cooper, who is the Director of Carbon Markets at CBA, Vivek Dhar, who is the Director and Mining and Energy Economist at CBA, and we also have the pleasure to be joined by Elisa, who is a partner and Head of Climate Change at Norton Fulbright. So our panel will provide you with an overview of the reformed safeguard mechanism and its implications, including the role of carbon markets, the support measures that will be available for scheme participants, and we'll be discussing the potential impacts on future industrial projects. So with that, let's dive in. Scott, if I may start with you and ask, why are these reforms occurring and what are the differences between the original and the updated scheme, and what in your view is driving these changes?
Thanks, Yasmina, and thanks everyone for joining us here today. So if we go back on the 30th of March, we had the safeguard mechanism reforms pass both houses of Parliament. And this legislation was the second major pillar of the Albanese government's climate change policy architecture. The first was the move last year where we enshrined Australia's emission reductions targets into law. So as Yasmina mentioned, that's 43% compared to 2005 levels by 2030, and also to achieve net zero by 2050. So the reforms have now been legislated, but if we give you a quick recap, what's a safeguard mechanism? So that's our legislated framework, and that applies to the top emitters in the country. These are facilities that emit more than 100,000 tonnes of scope 1 or direct emissions, direct on-site emissions. So if you think about who are these facilities, these are mining and gas operations, this is steelworks, this is aluminium, cement producers, waste and transport. And each of these facilities has an emissions limit or its baseline. Now, in terms of, I guess, why these reforms have kicked off and what are they addressing, this mechanism has been in place since 2016, but the baselines had too much headroom. And what that means is that the limit for each facility was very generous versus their emissions output. So we've got a revision to those arrangements, which will reset the baselines to generally around current emissions levels for each of those covered facilities. There will be an annual reducing baseline, and so this is each facility doing its proportionate share of the country's legislated climate target. And if you look as well, what was missing and what we now have is that we've got the introduction of a tradable credit known as a safeguard mechanism credit. And the way that I think about that is that's your financial incentive to each facility. So those facilities that now beat their emissions baselines on an annual basis will be credited with those safeguard mechanism credits. So we've got reducing baselines, we've got resetting baselines, and we've got that new financial incentive. We've also got further compliance flexibility being introduced. There's a cost containment measure, which I'll talk about in a moment, as well as funding support for certain hard-to-abate facilities. So it's not just the stick of the carrot and the stick. The funding support is the carrot arrangement. So these reforms, they are driving industrial decarbonisation. So when you think of Australia's emissions budget, we've got industry, we've got small business, we've got agriculture, we've got households. So that 28%, that's the big emitters in the country. And we've now got a simple, cleared up scheme to get on with the job. And for those who might look at it and say it's not perfect, that may be the case. It's a very good position we're in, and there will be reviews and there will be changes that are possible through time to strengthen it as required. Thanks, Yasmina.
Thanks, Scott. It's clear from what you're saying that the negotiated reforms are obviously designed to make a significant contribution contribution to meeting Australia's emissions reduction targets, and it's therefore a step forward in realising Australia's climate ambition. As we all know, however, the devil is in the detail. So if I could now turn to Elisa, what can you tell us about the stronger reporting obligations within the reforms, so including the requirement to report the use of more than 30% carbon offsetting to meet compliance obligations? And in a related thread, where does the integrity of the ACCU scheme come into play with all of this?
Thanks, Yasmina. So as viewers might be aware, the scheme was heavily negotiated before it got passed through Parliament between Labor and the Greens. And one of the Greens' concerns was essentially how it could get comfort that the facilities covered under the safeguard mechanism were actually reducing emissions rather than essentially offsetting their way through compliance. So there is the ability under the scheme to use the new credits that Scott mentioned. So the safeguard mechanism credits, they can be used for compliance purposes if a facility's emissions output is greater than what their baseline is. But there's also the ability to use Australian carbon credit units, or ACCUs, that have been around and operating now for many years. So rather than the government agreeing to have a cap on the number of ACCUs that could be used for compliance purposes, instead there is going to be this transparency requirement whereby those facilities that are using more than 30% of ACCUs to reduce their emissions to get them below their baseline will essentially have to report to the Clean Energy Regulator as to why they're doing that and why they're not able to reduce their emissions within the facility itself. So that might be for reasons related to the cost of reduction. It might be because the technology is not available. So there might be a number of reasons why it's necessary for a facility to go out and buy ACCUs rather than reduce emissions at source. There were also a number of other amendments that were introduced as part of that negotiation with the Greens. So the Greens were very conscious of wanting some comfort that the ultimate goal of 43% would be achieved. So there's now kind of built in this transparency layer in terms of reporting that needs to take place. So the Clean Energy Regulator is required to report on an annual basis the emissions coming out of each facility, whether safeguard mechanism credits have been issued to that facility, how many ACCUs have been used for compliance purposes, and also, interestingly, where those ACCUs have come from. So what project types those ACCUs are associated with. The other one of the other transparency measures is that the Climate Change Authority will be given the requirement to kind of keep track of where emissions are going, and in particular the implications of any new entrants coming into the scheme, but also any expansions, and how that will impact on that overall 43% objectives. So the idea is that annually there will be data captured and released which shows annual emissions, net emissions, so the amount of offsetting that's taking place, but also where we're tracking in terms of that 5-year average reduction, all designed to make sure essentially we're on track, and so that the government can pull levers if needed if the data is showing we're not on track. In relation to the ACCU integrity scheme, just briefly, viewers might know that there was a review commissioned by Labor when they came to power. There had been a number of criticisms about the scheme. And so Professor Ian Chubb, ex-chief scientist, was asked to commission a review looking at the integrity. Essentially, the outcome of that review was a conclusion that the scheme is generally sound, but that there are some improvements that can be made. And one of the key improvements is, again, related to transparency. I think the concern was that there is some data that is produced under the ACCU scheme that is not accessible at the moment, so some project level data, and it was felt that if there was more transparency in relation to that data, then it would give those outside the scheme greater comfort that the credits that are being issued do actually relate to genuine emission reductions and that can be tested by independent parties. Back to you, Yasmina.
Thanks, Elisa. That's a really helpful explanation. Just building on that, Vivek, if I can pull you into the conversation as well, could you please explain the scheme's share of the national emissions budget and how that's changed from a policy perspective under the Labor-Greens deal?
Sure. Thanks, Yasmina. So look, in terms of what's been announced and what's coming through, the safeguard mechanism, as Scott pointed out, accounts for about 28% of Australia's emissions. Now, what the government position paper did in January was basically say that the safeguard mechanism has to do its own equitable share of reducing emissions like the rest of the economy. So it has to reduce it 43% from 2005 to 2030. And with that comes an allocated budget for carbon emissions over the next 7 financial years. And with that also comes a point target by 2029-30. So those were really what came through. But what perhaps is the most influential part of what came through in that January paper was that they outlined a decline rate of 4.9% every year. Now, the way that this has been structured, basically what the government is asking of the safeguard mechanism and its facilities is that on average, a facility will have to reduce its emission intensity cumulatively about 34-35% over the next by 2030 to be fully compliant. And if they can't, they'll have to buy carbon offsets. And this is something that is quite onerous when you look at what else has been achieved elsewhere in the market. So for instance, if you look at the national electricity market, in the 7 years from 2014 to 2021, we basically only saw emissions intensity reduction of about 24-25%. So this opens the door for carbon compliance demand. Now, if you look at where the deal was struck, I guess, with Labour Greens, is that there's a focus on gross emissions. And as Elisa pointed out, what gross emissions means is that there's an enormous focus now on on-site emission reduction. When you talk about just net emissions, you are actually indifferent between carbon offsets and on-site emission reduction. So we are definitely seeing that bias come through when we look at what has come through in that Labour Greens deal. But now, if we shift to what the Labour Greens has specifically mentioned, particularly this absolute cap on pollution, what that is now looking at is ensuring that gross emissions is declining over time. Now, the way that the rolling average works, if we do see safeguard mechanism gross emissions stay at 2021-22 levels, then it only breaches that measure in 2027-28. So you can see that even though that this has come through, it is not actually that onerous. But the part of the policy that becomes quite onerous is this pollution trigger, which now means that every new project has to be aligned with declining gross emissions over time. And so this is where there's going to be an interesting mix of how do new projects now mark themselves against this rolling decline in gross emissions for the safeguard mechanism. Now, even if there is a breach, there is going to have to be a public consultation, and then at the end of the day, there's enormous discretion given to the minister in charge of the safeguard mechanism. But what I really want to highlight, though, is that a breach may mean that we could see the safeguard rules change. Now, that could block the new project potentially, but we could see existing baselines move. So you're shifting the goalpost already. And this is probably the key takeaway to see from the Labour Greens deal, is that the amount of times or the occasions in which the goalposts can shift have increased. So not only just when a new project comes in, but if that annual test fails. And that is something that is certainly worth watching as a follow-up from the Labour Greens deal that we saw.
Thanks, Vivek. I think that's been a really comprehensive overview in terms of the safeguard reforms, the implications, and the rationale for the changes. What I'd like to now do is move from the what to the so what. So, Scott, turning to you, how then should companies be thinking about their carbon exposure?
Thank you, Yasmina. And yeah, definitely some worthwhile points to weave in there from an integrity perspective that Elisa made, as well as the emissions budget that Vivek was making. So this is probably a new thing for many facilities to consider. And the reason why, and it goes back to my earlier point about the emissions budget, is that because there was so much gap, so much headroom between the baseline and the emissions, there was very little compliance related activity through ACCU procurement and surrenders, so Australian Carbon Credit Unit surrenders, in relation to excess emissions. And that meant that whilst this has been around for a while, a lot of businesses, and there are 100 odd companies that conduct the 219 odd safeguard facilities, a lot of them haven't had to come up against this compliance risk management of their carbon exposure perspective. Now, in saying that, many of the companies that are in the safeguard mechanism with covered facilities are leading the way with their voluntary commitments. So they've got decarbonisation plans in place. They are measuring their emissions. And so whilst this compliance aspect is a new bit, it does sort of fit in with what's already sort of underway. And many of these companies will have a carbon price or a shadow price for carbon that's woven into their decision making. But if you were sort of starting at this from scratch today and were sort of work it through end to end, corporates need to be modelling their carbon exposure through to 2030 and beyond. It's then a matter of looking at, well, what is my emission reduction pathways? So what are my abatement options? Where can I spend money to fix a leak around a facility, to invest in new plant that is going to change a process and reduce my emissions profile? So this is part of that developing a marginal abatement cost curve. So once you've taken your exposure estimate and you've looked at the levers that you can pull, the money that you can spend to decarbonize and what that looks like through time, you then want to be having a look at, well, what's the market price for carbon? As I mentioned, many of the companies that operate safeguard cover facilities, they have their own shadow price for carbon. When we've gone and scraped through reports, it's around about $100 a unit, and that's well in excess of the current generic ACCU price, which has sort of been trading between $38 and $40 for the last few weeks. Once you've gone and worked out your exposure and those pathways and you've looked at the price outlook, you then want to look at the how. And so what that means is the trading capability within your business. And so what that would look like, as an example, if you had a portion of emissions above a baseline through time and you viewed that as your exposure, what could you do about it? So you could look at, say, Australian Carbon Credit Units ACCU forwards. You could be looking at a large spot purchase, and you would just take delivery of those units in your registry account and hold them through time for upcoming surrenders. We've talked a little bit about the safeguard mechanism credit now happening. It's just that they won't be credited until the first round of the FY24 reporting period. So it means that SMCs will exist in the first quarter of 2025, but for the time being, ACCUs is your market indicator. So alongside setting up accounts, you want to then look at the trading capability, as well as policies, accounting, reporting considerations. You'd want to look at your trading documentation, which is more relevant when you are looking at, say, ACCU forwards, how that weaves into your negotiated ISA documentation. You may be looking outside of hedging with outright ACCU purchases or ACCU forwards by doing offtakes direct with developers. So all this sort of weaves into your procurement strategy and getting the plumbing hooked up. I think as well, something that is definitely on the to-do list for these businesses is that you'll need to be preparing your site-specific emissions intensity applications. Try saying that fast a few times. And this means that you submit your application, and this is going to drive or go part of the way into setting your baseline for the FY24. The other important thing that I think it's worth calling out is that I mentioned about the carrot and the stick, and the carrot is the funding support that has been made available through the government's Powering the Regions Fund. So examining whether you're eligible for this funding support, and then can that be used? So can that concessional finance contribute to your investment towards your emission reductions pathways? So that's sort of how we think about it, Yasmina, and that's the sort of the order of events when we talk to our clients. The best time to be doing this is yesterday, and the next best time is today. So we're always happy to be engaging with clients on getting ready for their upcoming compliance obligations.
Thank you, Scott. I think that was a very helpful way of putting things in perspective in terms of the practical application of these reforms and changes. Now, as we've seen in the press, much of the business sector has welcomed the certainty that's come with these reforms in the policy environment. However, the gas industry has obviously raised some concerns. So, Vivek, I'd love to ask you what, in your view, are the potential impacts on the domestic carbon market of the changes affecting gas producers specifically?
Sure. So look, this is where there's probably been the biggest changes when it comes to forecasting ACCU demand or carbon offset demand over the next 7 financial years. So the first, I guess, change, which in many ways many were expecting, given that the Beetaloo Basin in Northern Territory is facing a different set of rules, and this fundamentally comes down to the Pepper Inquiry and Recommendation 9.8, which basically means that you're looking at almost abating Scope 1, 2, and 3 if that Scope 3 emissions takes place in Australia. And that was a recommendation endorsed by the government as well. That's the Commonwealth government. And so therefore that becomes a very special case in terms of how does carbon offset demand work. Now, what has been announced following the Labour Greens deal is that at least it'll have to be Scope 1 net zero, but potentially you'd have to expand that to Scope 1 and 2 net zero, and even there's a situation where we could see Scope 1, 2, and 3 net zero. And whether that obligation and who will pay for it, these are all risks which are very much live. Now, in terms of how we've approached it, now, one of the biggest gas producers in the Beetaloo Basin, Tamboran Resources, they are looking to, by their own accord, look to be Scope 1 and 2 net zero. And so we've assumed that that will probably be the obligation that will come through for new Beetaloo gas producers. But obviously, we'll wait and see where exactly that lands. But that in itself is quite substantial, because even then, we're talking about 10 to 11 million tons of ACCU demand over the next 7 financial years. And to put that number in context, if you look at ACCU supply in 2021, 2022, we're talking roughly 16.5 million tons. So 10 to 11 accumulated is actually quite a sizable number. So the Beetaloo gas basin is certainly one big change. But then when you delve into where the biggest change has occurred, it is certainly with the existing LNG gas facilities that now have to shift from old gas fields into new gas fields. And there's a number of them that are impacted by that. Now, what has changed? It's not that they've been told they have to be Scope 1 net zero. What they've been told is that their reservoir emissions have to be zero once they go to the new gas field. Now, the reason why I'm quite pedantic about that is that it does change their compliance obligation. And to put some numbers around it, if you look at the draft environmental impact report for Economist, when you talk about reservoir emissions, that accounted roughly about a third of their Scope 1 and 2 emissions. And so it is very, very sizable, but it's not the complete picture of their emissions profile. But now when they move to their new gas field, they're not going to be given any allowance for those reservoir emissions. And this is going to be quite a big leap in compliance demand for these facilities. And the ones that are looking to do it this decade, we're talking Darwin LNG, we're talking Economist, we're talking Prelude, and we're talking Pluto Train 2. So all of these now will have to buy most likely carbon offsets, because to really handle these or reduce on-site emissions for reservoir emissions, you need to get carbon capture and storage up and running. And really, the only project which is in the area which is a possibility is the Bayer Undun CCS project. And in our view, that's probably a 2030 plus story. And for that reason, we think carbon offset demand from these specific facilities looking to go to new gas fields is going to be quite substantial. And so, we're talking, 20, 21 million tons accumulated ACCU demand over the next 7 financial years. And so this is, netted out. If we look at the Beetaloo and we look at what's coming from these existing LNG facilities, we are talking, in the order of 30 to 33 million tons. And so it's quite a sizable pickup in demand, particularly from the gas sector, as a result of these changes under the Labour Greens deal.
Thanks, Vivek. That is indeed a very significant, some very significant numbers you're throwing around there. Just while you've got the mic, I might also ask your opinion. If we look at the other end of the spectrum, what's your view of the impact of the concessions that are being provided to the value-added manufacturing facilities in hard-to-abate sectors?
Sure. So on the other end of the coin is that we saw concessions given to value-added manufacturing in hard-to-abate sectors. Now, the pool of value-added manufacturers under this definition is actually first undefined or unclear at this stage, but we have seen the wording and we're trying to look at it from a few sectors only. So we've been quite low in terms of the sector allowance in this definition. And we're looking at aluminium, alumina, steel, and cement as the only real facilities which have access to this concessional emission intensity reduction rate. So now they can access a 1% decline rate in emissions intensity, whereas previously the minimum was 2%. So, that means that every year, instead of doing a 2% decline rate in emissions intensity, they can now do 1%, therefore reducing their compliance burden. But the other change, which actually affects more manufacturers, right? In particular, it affects more trade exposed and other manufacturers as well, is that there's now access to the Powering the Region Fund. So this has been expanded from 600 mil to 1 billion and will focus for safeguard facilities and will focus particularly on decarbonizing the manufacturing sector. So this will also be a positive, but it's something to see how the allocation of that Power of the Region fund will work out, and exactly how that financing will eventually be decided. But those are the concessions that I think have been given to the value-added manufacturers in hard-to-abate sectors. And the way that we've kind of modeled this impact, and this is probably the trickiest part of the analysis, is that by reducing incentives for these manufacturers, you will likely see a reduction in actual emission intensity reduction. And so for us, this is actually quite important, because say there's a facility that before the Labour Greens deal was looking to cut emissions intensity by 4% every year. These concessions could mean that they're now thinking, oh, we can do 3% and that's okay. That makes more fiscal sense for us to do that. And so mapping that is challenging because, of course, you have safeguard mechanism credits, which make overreaching your baselines very attractive financially, and you can bank those in future years. But regardless of how you look at it, we do think there should be an impact calculated for this. And for that, we've assumed 100 basis point decline across the facility. So doesn't matter which aluminium, alumina, steel, cement producer you are, we're going to cut your emissions intensity decline ambition based on these new measures. And cumulatively, this does have an impact of about 8 to 9 million tons of reduced carbon compliance demand. So you can see that this is working on the other side, whereas for the gas sector, you increase gas demand, or you increase carbon compliance demand. On the manufacturing side, you're actually going to reduce carbon compliance demand. And, when we net out this whole result, in our base case, we're talking overall an increase in carbon offset demand in the next 7 financial years of about 22 to 23 million tons. So this is more than what ACCU supply was in 2021, 2022. And a lot of that increase in carbon offset demand will happen after 2026, 27, because that's when a lot of those gas projects come up. And so for that reason, it increases the risk of shortfall later this decade, particularly given our view of the ACCU market before the Labour Greens deal was one that was balanced. So that's probably the outlook that we're looking at. And look, in an upcoming note, we will detail more information on supply, demand, and prices. But so far, that's been the key takeout of the Labour Greens deal.
Thanks, Vivek. That's very clear, and we're very much looking forward to the note that you're going to release. Now, I just want to move towards the type of offsets that could be used. So I'd like to turn to Elisa. Now, we know that the reform scheme only permits the use of safeguard mechanism credits and Australian carbon credit units, or ACCUs, for compliance purposes. So within this paradigm, what, if any, is the role of international offsets?
Thanks, Yasmina. Well, it's quite interesting, I guess, just having heard Vivek's comments on what that demand is going to look like in the future, and whether, I guess, there is going to be the ability for the safeguard mechanism credits and the ACCUs to be able to fulfil that demand. So it's really in that context that we need to consider international units. Essentially what the government's done is parked its position or reserved its position around allowing international units into the scheme. There was, as you would expect, quite a lot of support from those sectors and those facilities that are covered under the scheme to be able to use international units. And primarily the main reason for that position is obviously voluntary carbon credits that are able to be accessed at the moment on the international market are in the main quite a lot cheaper than the current ACCU price, so trading significantly below the kind of current market price of around that $38 mark. So clearly in a context where those who are going to be faced now with this compliance obligation under the amendments want to be able to satisfy that compliance obligation at the lowest cost, it does make sense for them to be able to go out and access cheaper credits, subject, of course, to those credits being high quality credits, and I'll touch on that in a moment. So what the government has said about international credits is that it will do a review later this year in terms of assessing what frameworks would be put around the ability to essentially import international credits and use those for compliance purposes. And that is likely to be relevant not just for the compliance market, so not just for safeguard mechanism facilities, but also for others who use international credits on a voluntary basis. The backdrop is, in terms of, I guess, the government's position at the moment, is that under the former government, under the coalition, there was actually a review commissioned that was undertaken by the Climate Change Authority, who looked at the ability for international units to be brought in to Australia, and particularly in the context of what is happening at the moment with Climate Active and the use of international units under that scheme. So it's perhaps just worth noting as a side note that the coalition had changed the policy on how many on how many ACCUs needed to be used for compliance purposes under Climate Active. So previously there was no kind of minimum threshold. The coalition actually introduced a 20% requirement for Climate Active participants to use ACCUs. But as a result, both of the Chubb review and I think of the position probably in the broader context of the safeguard mechanism changes, the government has decided not to pursue that 20% ACCU requirement for Climate Active participation. And I think obviously one of the factors possibly behind that, having heard what Vivek said about that future demand, is the fact that there needs to be sufficient ACCUs available to safeguard mechanism facilities to use for their compliance obligations. So further work still to be done on international credits and whether they'll be able to come in and be used under the scheme. The other thing that the Climate Change Authority did also recommend was the government preparing a national carbon market strategy. So we're anticipating that we might see that come forward in due course. Perhaps just then reflecting briefly on the international market and where it sits at the moment. And one of the things I mentioned earlier was that we had seen a number of criticisms coming forward in relation to our ACCU scheme, so our own offset scheme. And we're seeing that kind of replicated significantly at that international level. So there have been and are starting to be a lot more criticism and concerns about the voluntary carbon market. And it's twofold. It's the quality of the credits that are being generated, and it's also the use of those credits. So there is this broader concern that if companies are, as a matter of principle, allowed to keep offsetting and there isn't any restrictions around that, then it means they're going to be less inclined to find ways to actually reduce emissions at source. And obviously that has, I guess, the most relevant application in terms of those that are in industry sectors that have a large emissions profile, such as our fossil fuel sectors and our other resource type industries. But there have been now a couple of key initiatives that have come out at an international level that are focused on those two aspects, so integrity of credits and integrity of use of credits. So the first one is the Integrity Council for the Voluntary Carbon Market. This was established and came out of a task force that was set up to look at how we scale the voluntary carbon market to meet the future demand and the role that the voluntary carbon market can play in terms of an overall Paris objective of net zero by 2050. And so the Voluntary Carbon Market Integrity Council has been working now for a year or so on setting out some core carbon principles in terms of what is needed in order to demonstrate that the credits that are being generated are high quality. So there's 10 principles that they've laid out. They've also laid out an assessment framework. So obviously there are a number of different standards that exist at an international level which allow people to go and do carbon projects and generate credits. And we're seeing those standards and the interest in those standards expand. So there'll continue to be more of those standards. So the Integrity Council has essentially set out an assessment framework as to how to assess whether those standards are going to produce high quality credits. So that work in terms of the core carbon principles has just been finalised and released, and now there'll be an implementation phase for the Integrity Council to roll out. The other key development is on really the use of offsetting or credits side, and that is another voluntary carbon market integrity initiative body that has been set up. And what that entity has done is release a draft code of practice on claims. So in terms of claims that corporates are making about whether it's carbon neutrality or their position in terms of their trajectory to net zero, what are the appropriate claims to be made in that context? And in particular, what is the appropriate way to use carbon credits in terms of achieving those long-term aspirations? And perhaps just one thing I think to note that we feel is going to get more traction is this idea that there's a need to do both. There's a need to reduce emissions along a Paris-aligned trajectory to net zero by 2050, but there's also a need to offset those emissions on the way to that net zero target. So it's a twofold requirement, if you like, looking at ways to reduce emissions within the footprint of a facility or an organisation, but also offsetting those emissions as you go. And certainly that's what the Voluntary Carbon Market Integrity Code of Practice is promoting. And so I think there's going to be a lot of pressure, and what that means is obviously more demand for credits, so not just for ACCUs but also for international credits.
Thank you, Elisa. That's incredibly clear and comprehensive. And I just want to pick up on the pricing point. I mean, both yourself and Vivek mentioned it. So Vivek was sort of referring to it by virtue of the shortage that we're going to be facing in the coming years. And obviously, Elisa, you alluded to it when we sort of compare against the price of international offsets. So I'd like to bring Scott back into the conversation. And we know that at the moment, in a bid to sort of shield business from the risk of future cost spikes and to provide additional certainty, there has been an attempt to cap the carbon price for safeguard facilities to manage that cost. Could you please talk us through that in more detail?
Thanks, Yasmina. Absolutely. So I mentioned earlier about flexible compliance arrangements, and that includes banking. So if you own an ACCU or when you own SMCs, you can hold on to them and use them through time for your compliance purposes. You can also do what's called borrowing. So you can borrow from your baseline, and that means that you can receive the benefit of next year's baseline for this year's compliance purposes. But in addition to that, we've got this cost containment measure, which, as Yasmina mentioned, there were concerns about price volatility and cost constraints, and that was one of the big things played back to the government during the consultation phase. So we now have a cost containment measure, which, again, as Yasmina mentioned, it was an attempt to cap. But if you sort of read about it in the media, you'll hear it categorized as a price cap. And we spent a bit of time talking about this particular point, and it's really interesting because, yes, the government will make their government-held ACCUs available for purchase at a controlled price, and so that would be when a facility cannot source ACCUs or SMCs on the market. The government will supply their available inventory of ACCUs at $75 a tonne in the financial year 23 to 24, and then it'll escalate annually at CPI plus 2%. So the government doesn't have a very large inventory of these units, and the reason why is that as one of the major buyers in the carbon market through carbon abatement contracts, the deliveries to the government prior to the start of this year were surrendered, and they go towards our nationally determined contribution, which, as Elisa was mentioning, we've made Paris commitments and we have our NDC on the back of that. So we surrender these units and it goes towards that nationally determined contribution, our NDC. That's now changed. So the deliveries that the government receives from the start of January thereafter will be used to build that inventory. And there's also another mechanism under the Powering the Regions Fund. So Vivek was talking about the financing that's available for it, but the Powering the Region Fund can also use any funding it has to purchase and enter into ACCU contracts. And the reason why we think this is particularly interesting is that businesses look at their exposure, their planning, as I discussed earlier, their emissions, what's the abatement, how do we then go and risk manage this exposure? But if you're relying on that price cap, that attempt to cap prices, that cost containment measure to be there, you just need to be aware that there's those limitations that I mentioned in terms of the government having sufficient inventory to supply the market. So you could imagine a scenario where the ACCU price is through that control price, and then businesses would be able to access the cost containment measure, but there could be a scenario where there isn't sufficient inventory. And the reason why we're concerned about the inventory is that it's just not clear that the government will be able to bring in sufficient inventory under the current arrangements. And that's due to a couple of factors, but the big one is that the existing carbon abatement contracts and the associated deliveries to the government, those contract holders can actually break those contracts, pay an exit price, and then sell into the secondary market. And the cumulative cost to get out of that contract is around $30, we suspect, and the market's trading on that. So you've got a risk-free profit just waiting there for you. So that's one of the big question marks for us in terms of how's the government go and build sufficient inventory, a sufficient hedge, so that they can give the market comfort on this cost containment measure, which is really important, as business told the government, in terms of the concerns about the price volatility and the cost constraints. And this was in the consultation period. This is before the Greens Labor deal, which, as Vivek mentioned, his insights is that there is a big potential buying need from those gas facilities due to the changing arrangement. Now, this is a really tricky area to go into, and if you want to pick apart the demand supply outlook, CBA Research has got some notes on this point. However, we just want to call that out as something that we're watching. It's not yet clear, and we think it's really important to get to the bottom of it. But it also goes back to what can business do about this. My earlier points on looking at your exposure, your abatement options, modelling the position, and then work out whether you're going to start to build a hedge for your own carbon exposure, noting that yes, there's a control price that will start at $75 a unit, but the market is below $40. So there's opportunity to think about this this potential problem and your approach today and make a decision accordingly. Thanks, Yasmina.
Thanks, Scott. I think it's really important to call out those nuances. Now, finally, I am very keen to open the questions to the floor, but just before we do that, I'd like to just look forward to what we might expect in the near term beyond what we've discussed already. And with that, Elisa, what can you tell us about some of the other key initiatives that are in train, like, what's still to come in the Safeguard rules or the potential for a carbon leakage review?
Thanks. So I think the context to be conscious of is that the safeguard mechanism reforms, as has been outlined, only apply to 28% of Australia's emissions profile. So there's the balance of 72% that still needs to be addressed to get us to that 43% target by 2030. So in that context, the question is, well, what are the other regulatory or policy settings that might be needed to deal with those other sectors that aren't actually covered by the safeguard mechanism? So if we think about energy as being the obvious one, that has a kind of a special arrangement at the moment under the safeguard mechanism because it operates under kind of a global baseline rather than an individual facility baseline. But we know that there needs to be a significant increase in the amount of renewable energy that's rolled out in the lead up to 2030 and beyond. What are going to be the drivers for that new development? The renewable energy target per se, is kind of, I guess, not that effective anymore. So how do we get significant investment coming into that sector? And I think really importantly, what we've been seeing in our practice, what are the roadblocks? How do we actually deal with some of those roadblocks to getting large-scale project rollout happening at speed and at scale? There's the whole issue about hydrogen and what role that's going to play, obviously, in our energy space, and not just obviously for generating electricity within Australia, but also as an export opportunity. And there's still a lot to play out in terms of the role that hydrogen will play. Transportation sector is a really interesting one. So I think the other thing to realise about the safeguard mechanism is it's designed to be just at that facility level. So if the facilities are not high emitters, then they don't get covered. And the transport sector has always been a challenging one because it's you and I driving our cars that and burning the fuel in our cars that contribute to that sector of emissions in Australia. So how is that sector addressed? We know the government has now released a electric vehicles strategy and will be setting some fuel efficiency standards. So that's kind of a step in the right direction. But how does that approach get rolled out to not just cars, but then trucks and other types of vehicles that also need to look at how they electrify? And then probably the last sector, the main large sector of our emissions profile, which is our land use and ag sector. So what's done to address emissions growth and to achieve reductions in that sector is it sufficient just to have the ACCU scheme as a voluntary mechanism that people can participate in? Is there a need to look at ways to regulate, emissions coming out of that sector? And obviously, the kind of one of the easy options, which is always a fraught option, is land clearing rules and reducing the ability to clear land in terms of maintaining existing vegetation and sequestration. And then perhaps just the last thing to touch on is a mechanism that has been identified as one that the government is going to look at, which is what's known as a carbon border adjustment mechanism. So this is something that Europe kind of put out in the first instance, which is really how, when you've got a carbon price within your country or your nation, but how do you deal with imports in that aren't subject to the same carbon price or same carbon constraints in the country from where they're coming from? And how do you then put in place a price differential to ensure that your existing companies producing those same goods and services aren't prejudiced by the ability to import goods and services at a lower cost that don't have the same carbon price enshrined within them? So the government has said that it will do a review of whether that mechanism is something that should be considered as part of the broader policy scheme, and particularly focusing on steel and cement as kind of the two main sectors that are likely to be impacted from that international competitiveness issue. So yeah, I think lots still to come in terms of how we actually get our country on its trajectory to the 43% and beyond that, the net zero by 2050.
Thanks, Elisa. Now, I'm just conscious that we are about 8 minutes to time, so I would love to ask everyone, attending the webinar to please submit their questions online. We've got a number of questions coming through already, so I might bring the other panelists in. Now, the first question, if I could throw this out, possibly towards Vivek, are you able to go into more detail about how facility baseline is calculated?
Sure. And I know Scott. I know Scott answered this question a little earlier, and he went into some detail. But really, where we're seeing the shift come to at the individual facility level is that initially the bias will be site specific. So we're talking 90% of your emissions intensity baseline will be based on site specific. By the time you get to 2029, 2030, we're talking, we're going to move completely to the industry average. So what this means within each sector is that if you are more carbon intensive than your peers, you are probably going to see, or very likely going to see, a much more aggressive baseline reduction rate. So by sector, say on average it's 4.9% you have to decrease. You're going to have to probably do more than that if you're more carbon intensive. And similarly, if you're below the industry average, your carbon compliance obligation is a little less. But this just goes down to how this is now being modeled. Is your facility relative to the industry average is very, very critical into understanding exactly how your baselines will look from now till 2029, 2030.
Thanks, Vivek. We have another question coming through here saying, do you see a future in which we're likely to see the safeguard mechanism expanded to cover a greater share of the country's emissions? So I might throw that one to you, Elisa.
Yeah, so I think it's quite conceivable, as I said, only because at the moment it's roughly a quarter of Australia's emissions that are currently covered. I mean, an obvious way, I guess, to expand the scheme is to lower the threshold. So at the moment it's 100,000 tonnes of emissions, but historically we had it at a level of 25,000 tonnes, and certainly that would be consistent with the data that's already captured through the National Greenhouse and Energy Reporting Scheme. So certainly that's an easy way for the government, if it wants to get the scheme expanded out to get more participants, would just be to lower that initial threshold. In terms of, I guess, scheme coverage itself, as I've identified, there are some challenges with, for example, rolling it out to the transportation sector that need to be factored in, and also agriculture and land use as well, in terms of who wears the liability for compliance. And certainly, if we go back a very long time in time, when the carbon pollution reduction scheme was initially floated by the previous coalition government, that is one of the issues that was sought to be grappled with at the time, and that is one of the key reasons why land use and ag sector has always been excluded from the scheme. So I think it's probably unlikely that we would see it expand out to that scheme, particularly, I guess, in a context where they have the ability to take action on a voluntary basis and participate in the ACCU scheme and generate a revenue from doing so, and in a context where we know demand for ACCUs is going to significantly increase. Hopefully that will be enough of a driver for that part of our economy to really make large strides in terms of reducing emissions leading up to 2030.
Thanks, Elisa. One more question around the impact of the announcements and the reforms on the ACCU market pricing. So, Scott, I might throw this one to you, and if you could just talk to what the impact has been over the last few months and potentially where we see it going over the coming period.
Sure. Elisa's earlier point on the integrity and on the Chubb review. So in January, we had the release of the findings of the Chubb review, and we also had the proposed safeguard reforms launch. So January, we saw a big month, a record month in ACCU, Australian Carbon Credit Unit trading activity through the spot market and through the forward market. It's worth pointing out that what we can see is what prints through the broker market. So it's by no means capturing every transaction that's changing hands. So as an example, CBA hold an inventory of units. If I was to sell a parcel of units to Vivek's facility, that wouldn't print in the market. So January we had a record print. February was a little bit quieter still. And then March, we had a little bit of a pop towards the end of the month because we had the Greens Labor deal announced. I guess the points to call out there is that we started the year closer to $30, and where we are today, we are closer to $40. So you can see that the comfort that's been delivered through the integrity review, through the Chubb review, and then the price signal that's been delivered through the enhanced safeguard mechanism has really put a bid tone into the market. The Greens Labor deal has been particularly interesting to think about where this additional buying is going to come from, as Vivek talked about. But you do need to weigh the supply side factors, and there's a number of considerations to weigh there. But all in all, we've had a positive response through price activity through the market. I think that's important that it didn't go too high and catch everyone off, and it didn't go lower, because that would have been particularly poor in light of the Chubb review. And from here, we will have to wait and see. Vivek, I guess over to you to release some research with a price outlook.
No,
I'm just conscious of time, and there's one more question I'd love us to answer, and it's probably directed at you, Vivek. It's around LNG fields, and the question is, if LNG fields are replacement fields, will the government give some concessions on baseline? And I'm going to ask you to keep your answer to 1 minute.
Sure. So in terms of what's been announced, that replacement field has been the exact one that's been targeted. So that's the one that have been told that it'll have zero reservoir emissions. So that has actually been the big change, is that there is almost a deliberate attempt to make sure that these fields, or these replacement fields, actually have to pay a higher carbon obligation for it. So in that way, I can't see them giving more concessions, given that they actually went tighter on them as a policy move. The one thing that I would say, though, in terms of which are the projects which are really going to struggle, it's or going to face a more significant cost, it's going to be the ones which have a higher CO2 content in that field. And that new field, in terms of where we see it, if we call significant above 5% of LNG revenue, and we try and project that out, we're only talking Darwin LNG and Ichthys as the ones which will have, a significant hit in that way on LNG revenue. So it sounds like it's manageable, but still very much moving the goalposts and making life a lot harder for the gas sector.
Thanks, Vivek. And with that, unfortunately, we are at time and we will have to bring our session to a close. I'd like to thank our expert panelists again, Scott, Elisa and Vivek, for taking the time and sharing your insights this afternoon. And thank you very much to everyone who dialed in. We've loved having you and we hope you found the session useful. Now, obviously, if you have any further questions in relation to this, please feel free to reach out to your CBA relationship banker and we'll take those questions. And we're wishing you all a lovely rest of the day. Thank you.